Adele holds the remarkable record for the most weeks at #1 on the Billboard 200 chart among female artists, a testament to her unparalleled impact on the music industry. With a soulful voice and deeply emotive songwriting, Adele has captivated audiences worldwide. Her albums, particularly 21, 25, and 30, have not only garnered critical acclaim but have also achieved remarkable commercial success. 21, released in 2011, is especially noteworthy, spending an impressive 24 weeks at the top of the Billboard 200, making it one of the best-selling albums of all time. This album featured iconic hits like Rolling in the Deep and Someone Like You, which resonated with listeners and showcased her exceptional vocal range. Adele's subsequent albums continued this trend, with 25 spending 10 weeks at #1 and 30 further solidifying her status as a powerhouse in the music scene. Her ability to connect with fans through themes of love, heartbreak, and personal growth has established her as a defining voice of her generation. With a total of 42 weeks at #1 across her albums, Adele's legacy in music is unmatched, making her a true icon in the industry. Sumer, located in what is now southern Iraq, is widely recognized as the oldest recorded civilization in history, dating back to around 4500 BCE. It emerged in the fertile region between the Tigris and Euphrates rivers, known as Mesopotamia, which provided the agricultural foundation for its development. The Sumerians are credited with a range of groundbreaking innovations that shaped the course of human history, including the invention of writing, specifically cuneiform, around 3200 BCE. This system of writing allowed for the recording of transactions, stories, and laws, fostering the growth of administration and culture. Sumer was composed of several city-states, such as Ur, Uruk, and Lagash, each governed by its own ruler and deity. These city-states engaged in trade, warfare, and cultural exchange, contributing to a rich tapestry of social and political life. The Sumerians excelled in various fields, including mathematics, astronomy, and architecture, exemplified by their impressive ziggurats, stepped temples that served as both religious and administrative centers. Despite its decline around 2000 BCE, Sumer's influence persisted through subsequent civilizations, laying the groundwork for future cultures in the region. Its contributions to writing, governance, and urbanization mark Sumer as a cornerstone in the narrative of human civilization. World War II was the most expensive war in history, costing an estimated $4 trillion in today's currency. The war was fought from 1939 to 1945 and involved the majority of the world's nations, including all of the great powers, eventually forming two opposing military alliances, the Allies and the Axis. The war was fought on multiple fronts, including in Europe, Africa, Asia, and the Pacific, and resulted in the deaths of millions of people, including civilians. The cost of the war was staggering, with the United States alone spending around $4.1 trillion in today's currency. The war had a significant impact on the global economy, leading to a period of rapid inflation and economic instability. Additionally, the war led to significant advancements in technology and the development of new weapons, including the atomic bomb. Overall, World War II was a devastating and costly conflict that had a profound impact on the world and its people. Its legacy continues to be felt today, both in terms of its impact on global politics and the ongoing efforts to prevent future conflicts. The lack of respect for real culture is a major disgusting problem. Exploitation of wealth and power abuses still continue to produce bad results that are totally unacceptable. How can we change the mindset of crooks who enjoy vast proceeds from being evil? People argue a lot. It's a feature of human society that people don't all agree, and some are unnecessarily offensive without self-restraint. It can be a full-time job policing your own personal security and working in ways that foil the schemes of those who think they can intimidate people with horrible threats. We have switched from candidate for the leadership role, promising best results for the electorate, so that now we have a motivation of unashamed, flagrant greed and aggressive self-advancement. This administration has spread the wrong message and now are beleaguered because of their mistaken interpretation of the United States political system at this time in the world. The people have caught up on the lies promised on the path to power. They were disillusioned when realizing how lacking in fiduciary commitment to the people of this nation, the opportunistic exploiters of class servitude were quite happily prepared to turn. Over the past week, physical gold has traded within a relatively tight range, fluctuating between roughly $4,550 and $4,800 per ounce. While this keeps gold near historically elevated levels, the lack of a decisive breakout may seem puzzling given the current economic backdrop. Inflation pressures remain persistent, geopolitical tensions continue to simmer, and financial markets are showing signs of strain. Under normal circumstances, this combination would drive gold significantly higher. Instead, gold has entered a period of consolidation. To understand why, it is necessary to look beyond surface-level headlines and examine how the underlying economic forces are interacting. What becomes clear is that gold is not lacking support, it is being temporarily restrained by competing pressures, particularly those tied to interest rates and currency strength. One of the most important factors influencing gold over the past week has been the Federal Reserve's stance on interest rates. At its late April meeting, the Fed chose to hold rates steady at 3.5% to 3.75%, signaling continued caution amid elevated inflation. As reported by LiveMint's coverage of the Fed meeting, policymakers acknowledged that inflation is still being driven in part by rising global energy costs. This acknowledgement is critical because it suggests that the central bank is not yet comfortable easing monetary policy. For gold, interest rates matter because they shape investor behavior. When rates are high, investors can earn more from interest-bearing assets, such as bonds or cash. Gold, by contrast, does not generate income. As a result, higher rates tend to reduce the short-term appeal of holding gold, even if long-term conditions remain favorable. At the same time, elevated rates tend to strengthen the US dollar, which further pressures gold prices since gold is priced globally in dollars. This dynamic was evident last week as highlighted in Kitco's report on gold declining ahead of the Fed meeting, where rising yields and policy uncertainty contributed to short-term weakness. While interest rates are acting as a constraint, inflation remains the underlying force supporting gold. Much of this inflation pressure can be traced back to energy markets. Oil prices have remained elevated, largely due to ongoing geopolitical tensions involving Iran and key global supply routes. According to recent reporting from the Economic Times, crude prices have remained elevated, reinforcing concerns that inflation could persist longer than expected. The reason this matters for gold is rooted in how inflation spreads through the economy. When oil prices rise, the effects are not isolated to energy markets. Transportation costs increase, manufacturing becomes more expensive, and businesses eventually pass those costs on to consumers. Over time, this creates a broad-based price increase, eroding purchasing power. Gold has historically served as a hedge against this type of erosion, which is why it tends to perform well when inflation expectations rise. Geopolitical risk adds another layer to this dynamic. Tensions in the Middle East, particularly involving Iran, have continued to influence both energy markets and investor sentiment. As noted in Times of India's coverage of gold price forecasts amid US-Iran tensions, ongoing instability is supporting safe haven demand for gold and silver. However, unlike earlier in the year, when markets reacted sharply to each new development, much of this geopolitical risk is now being absorbed more gradually. Investors are no longer responding to individual headlines, but to the broader pattern of sustained instability. Silver has followed a similar trajectory over the past week, although with greater volatility. Because silver serves both as a monetary metal and an industrial input, it tends to move more aggressively than gold in both directions. Reports from the Wall Street Journal showed that silver declined alongside gold during periods of dollar strength, but also rebounded more sharply when safe haven demand returned. This dual nature makes silver more sensitive to shifts in economic expectations, while still benefiting from the same long-term drivers that support gold. Another important, though less visible factor is physical demand. Central banks and long-term investors continue to accumulate gold as a part of a broader effort to diversify away from traditional financial assets. According to Kitco's reporting on global gold demand trends, physical gold purchases remain strong even during periods of short-term price volatility. This type of demand is significant because it provides a stable foundation for the market, helping to prevent deeper declines. Taken together, these factors explain why gold has remained range-bound over the past week. Inflation, geopolitical risk, and physical demand are all pushing gold higher, while interest rates and currency strength are holding it back. The result is a market that appears stable on the surface, but is actually building pressure beneath it. From a long-term perspective, this environment reinforces the case for holding physical gold, particularly within a precious metals IRA. The past week has demonstrated how quickly global conditions can shift and how interconnected the financial system has become. A change in energy prices can influence inflation, which in turn affects interest rates, currency values, and asset prices. Each of these shifts introduces uncertainty into traditional investments. Physical gold offers a form of stability that exists outside of these interconnected risks. It does not depend on corporate performance, central bank decisions, or the strength of any single currency. Instead, it has historically preserved purchasing power during periods of inflation, monetary instability, and geopolitical stress. Silver complements this role by offering additional upside potential, particularly in environments where both industrial demand and inflation remain strong. The most important takeaway from this past week is not that gold has stalled, but that it is balancing competing forces. While short-term movements may be influenced by interest rates and currency fluctuations, the underlying drivers of gold, persistent inflation, geopolitical uncertainty, and strong physical demand, remain firmly in place. For long-term investors, this period of consolidation may represent not hesitation, but preparation for the next phase of the gold market. Gold is flipping the script, and most investors haven't caught on. Peace talks are lifting it, war is pulling it down. If that feels wrong to you, you're not alone, but there's a clear reason behind it, and it ties back to oil. rates, and a bigger structural shift most people are overlooking. Why peace is bullish for gold in 2026 and war isn't. Gold is flipping the script. Here's what's supposed to happen when war breaks out in the Middle East. Uncertainty rises, investors flee to safety, and the price of gold goes up. That's the familiar war premium. It's textbook, it's reliable, and right now it's wrong. Since the Iran conflict began on February 28, 2026, gold has sold off every single time the war escalated. Meanwhile, every time peace talks surfaced, gold rallied. This pattern has repeated 5 times in roughly 10 weeks. That's not a fluke, that's a signal. So what's going on? And more importantly, what does it mean for you as an investor? Key takeaways: gold has sold off on every major escalation in the 2026 Iran war and rallied on every peace signal. The opposite of the traditional war premium, the cause is fiscal dominance. With U.S. gross federal debt now above 125% of GDP, markets need lower oil, lower inflation, and lower interest rates, and only peace delivers that chain. Oil and gold have shown a near-perfect inverse correlation since Epic Fury began on February 28, 2026. Central banks purchased an estimated 244 tons of gold in Q1 2026 alone. According to the World Gold Council, the long-term structural bid remains intact. For long-term investors, war-driven gold dips may represent buying opportunities while the fundamental thesis holds. Why gold sells off on war and rallies on peace in 2026. Pull up an hourly gold chart from late February through mid-May 2026. You'll see something striking. Gold was trading near $4,700 per ounce when Operation Epic Fury, the U.S.-Israel joint military operation against Iran, launched on the last day of February. Almost immediately the price dropped. It didn't stop falling until rumors of a 5-day ceasefire hit the wires. Gold bounced. Then those peace talks collapsed. The war escalated again and gold sold off once more. This pattern played out over and over. Escalation meant lower gold prices. Peace rumors meant higher gold prices. In nearly every instance, the market moved before the headlines even caught up. There was only one notable exception, a brief moment in mid-April when rumors about the Strait of Hormuz reopening and U.S. sanctions relief failed to lift gold. The market may not have found those reports credible, but aside from that, the pattern held firm. 5 reversals in 10 weeks, that's hard to ignore. How fiscal dominance is reshaping gold's response to war. So, why is gold behaving in the exact opposite way most people expect? The answer comes down to fiscal dominance, a macroeconomic environment where government debt levels are so high that fiscal sustainability, rather than traditional monetary policy, becomes the dominant force driving markets. The United States is deep in that territory. As of Q1 2026, gross federal debt stands at approximately 125% of GDP, according to CEIC data. Debt held by the public alone just crossed 100% of GDP for the first time since 1946, per the Committee for a Responsible Federal Budget. The World War II peak was 106%, but back then, debt declined from that level to just over 23% over the following 3 decades as wartime spending wound down and the economy boomed. Today, the U.S. is already at wartime debt levels, with no comparable runway to recover. This changes everything about how markets respond to conflict. In a fiscal dominance environment, one thing matters above all else. Interest rates need to come down. The U.S. government needs lower borrowing costs to keep its debt sustainable. It needs global demand for treasuries, and it needs low inflation. That's where oil enters the picture. The oil-gold mirror, a relationship most investors are missing. Virtually everything in the modern economy depends on energy. Manufacturing, transportation, supply chains, they all run on oil. So when oil prices spike, inflation follows. And when inflation rises, the path to lower interest rates gets blocked. War in the Middle East threatens oil supply. It risks shutting down the Strait of Hormuz. It puts energy infrastructure in danger. All of that drives oil prices higher and makes the U.S. debt situation worse. Here's the core insight since February 28th. When you overlay Brent crude oil and gold on the same chart, the relationship is almost perfectly inverse. When oil spikes, gold drops. When oil falls, gold rises. The mirroring effect is so strong you might mistake the oil chart for gold's price flipped upside down. The causal chain works like this. War pushes oil up. Higher oil drives inflation. Inflation blocks rate cuts, and elevated real rates are bearish for gold. Peace reverses the entire sequence. Lower oil, lower inflation, space for rate cuts, and a bullish environment for gold. That single sentence explains why peace has become the most powerful short-term catalyst for gold in this cycle. How the gold war peace cycle affects short-term and long-term investors. This is where it gets practical. The war versus peace dynamic affects investors very differently depending on their time horizon. If you think in days, this pattern is a short-term trading signal. You could try to ride the swings between escalation sell-offs and peace rallies. Some large institutional investors are doing exactly that. It's fast, it's volatile, and it requires precision timing. If you think in months, the war is probably noise. It's genuinely difficult to forecast whether gold will be higher or lower 6 months after the conflict began. Too many variables are in play. Diplomatic outcomes, oil supply shifts, Fed policy decisions. The honest answer is nobody knows with certainty. If you think in years, the war-driven dips may actually be buying opportunities. The long-term thesis behind gold hasn't changed. According to the World Gold Council, central banks purchased an estimated 244 tons of gold in Q1 2026 alone, exceeding both the previous quarter and the 5-year average. Sovereign debt levels keep climbing, deficits aren't shrinking, and central banks around the world continue to hedge against the fiat currency system by accumulating gold reserves. None of that changes because of a 10-week military conflict. The structural forces driving gold higher for years remain fully intact. So when gold sells off on a war headline, long-term investors can view it differently. Gold isn't breaking down, it's going on sale while the fundamentals stay the same. Why gold's long-term thesis still holds despite war volatility. Gold's recent behavior looks backward on the surface, but once you understand fiscal dominance and the chain reaction linking peace, oil, inflation, and interest rates, the logic becomes clear. Peace is bullish for gold right now because it is the only realistic path toward lower real interest rates in an economy carrying more than 125% debt to GDP. War disrupts that path by spiking oil and reigniting inflation fears. For short-term traders, that creates a tradable pattern. For long-term investors, it creates something even more valuable, discounted entry points into an asset with a thesis that hasn't budged.